Okay, let's unpack this. Our mission today is a deep dive into the surprisingly divergent world of global stock market performance in 2025.
Hmm.
Forget the headlines you read about, general economic malaise or global growth slowing down.
Right.
We are zeroing in on markets where local action produced some pretty extraordinary results, for better or for worse,
Exactly. We aren't just looking at the familiar haunts like the U.S., where the S&P 500 posted a solid 17.4% return.
which is a great return.
It is, or Japan's Nikkei 225 at a strong 26.2%. But the real story of 2025 is fragmentation.
Okay.
So we're analyzing 6 specific high-stakes indices, 3 that just soared, delivering these mind-blowing returns, and 3 that fundamentally lagged.
And the goal is to understand what local policy, what specific companies, and what sudden geopolitical shifts truly drove their outcome.
Because they were highly varied.
We have the exact figures and the stories behind them, and it shows incredible volatility and massive wins far beyond what most global fund managers would have predicted.
I think these 6 markets really reveal a fundamental truth about investing in 2025.
Which is?
Local context was everything.
We have to start with the high flyers. I mean, the sheer winner of 2025 and potentially the most astonishing index performance globally belongs to South Korea.
Like the KOSPI, yeah.
It achieved a phenomenal 75.7% return. That makes it the world's best performing main index by a mile.
It's an incredible number.
So here's where it gets really interesting. Why the near doubling of value?
The jump was a perfect storm, really. But the primary driver was this massive, concerted effort to break the market's chronic pessimism.
What do you mean by that?
Well, for years, the Korean market suffered from what analysts call the Korea discount.
Okay.
It's a low valuation status, depressed price-to-earnings, price-to-book ratios. In plain language, the market was just chronically cheap.
So what broke that cycle in 2025?
It was this confluence of internal policy and external demand. Internally, sentiment got a major boost from President Lee Jae-myung's public pledge to reach KOSPI 5,000.
A public pledge.
A public pledge, and critically, promises of deep institutional reforms. Things like easing labor union formation were seen as very pro-business.
So a policy tailwind.
A powerful one. And then on the monetary side, the central bank cut policy rates 4 times, down to 2.5%. Providing major liquidity into the system.
Wait, hold on. Is 75% growth truly sustainable if it's based partly on a politician's pledge and reform promises? That sounds less like market mechanics and more like a huge psychological gamble that just happened to pay off.
It was absolutely a gamble, rooted in sentiment, you're right. But that sentiment fueled a massive inflow of cash into specific, high-quality names.
Okay, let's talk specifics.
Semiconductor and technology companies just dominated the move. We saw 2 massive contributors. SK Hynix, a world leader in memory chips,
Right.
saw over 274% growth.
Wow.
And of course, Samsung Electronics gained nearly 125%.
2 names. That's the detail that just jumps out from the sources.
Critically, these 2 companies alone accounted for approximately half of the KOSPI's entire market value increase for the year. Half. That sheer concentration means South Korea wasn't some diversified market recovery. It was essentially a leveraged bet on 2 stock tickers.
So if those 2 had faltered,
The 75% gain vaporizes. That's the real insight here.
a highly concentrated win. Were there any other key components?
Yes, industrial firms also benefited. Companies like Hunisisung Industries, Hendia Rotem, Doosan Enerbility, and the defense and chemical leader Hanwha Aerospace all performed strongly.
Okay.
But I find this genuinely surprising. Individual South Korean investors were net sellers throughout this entire run.
They were selling.
They were. It signals this profound domestic skepticism. Even as foreigners and institutions were buying heavily in the second half, they missed the whole thing.
That's a fascinating look at a policy and tech-driven boom. Okay, now moving from a hyper-focused tech boom to a profound geopolitical rally. Let's look at Israel.
The TA-35.
Right. The index delivered a powerful rally, soaring by 51.6% in 2025.
And this was a rally driven almost entirely by sudden, unexpected geopolitical shifts that just restored investor confidence.
What was the key event?
It was a breaking news about a major ceasefire initiative for the Gaza conflict. Specifically, the reported Trump administration plan that came out on October 5th.
And that alone was enough.
That unexpected news pushed the index to record highs.
But that's a rally based on hope, not a guaranteed reality. Isn't a rally based purely on the expectation of a ceasefire inherently fragile? I mean, if geopolitical factors reverse, that confidence just evaporates.
It is fragile, absolutely. But the market priced in that optimism very aggressively. Foreign investors showed massive confidence, pouring $8.6 billion into the market in just the first 9 months.
That's a huge vote of confidence.
It is, especially when international capital flows in, despite ongoing regional instability.
And the specifics. I see a split here between defense and finance, which I guess makes tragic sense given the region.
It does. Defense hardware firm NextVision was up an incredible 253%.
Wow.
Clearly benefiting from the Russia-Ukraine conflict and sustained regional security demands.
And the financials.
Don't overlook that rally. It really speaks to the faith in economic stability returning. Insurance companies soared. Menora Miftachim gained 178%. Phoenix was up 165%. Harrell rose 151%.
And the big banks?
Major banks like Bank Leumi and Bank Hapoalim saw significant value increases. Leumi's market value went over 100 billion shekel.
So broad-based confidence in the financial system.
And Keva, the pharmaceutical giant, regained its status as the country's largest company. The whole rally signaled that investors believe the long-term economy is resilient, provided the conflict can be contained.
Okay, so a huge boost from geopolitical news. Finally, for the winners, let's go to Latin America. Chile's S&P IPSA index was highly responsive to political winds. It delivered approximately a 48% return.
The defining factor here, much like Korea, was domestic politics. But in Chile, it was a sudden change. The rally was triggered right after the first round of elections in November.
When the far-right candidate Jose Antonio Cast took the lead.
Exactly. And that instantaneously sparked investor optimism for pro-growth reforms.
So the market was pricing in the anticipation of deregulation.
Absolutely. Especially in key areas like pensions and capital markets. Analysts like Morgan Stanley were all over this.
And we saw that in specific stocks.
Oh, yeah. That 9% jump in SQM, the major fertilizer and lithium producer, right after the election news, that wasn't economics. That was the market pricing in pure political relief in real time.
And Chile is defined by its resources, so global commodity demand must have amplified this.
Precisely. Mining giants like Codelco and CAP benefited hugely from strong iron ore prices. It added momentum to that political bounce.
But I did notice that while mining was extremely strong, other sectors were more moderate.
And that's the nuance, right? Consumption and banking stocks were relatively mild compared to the commodity exporters. The rally was focused, reflecting that dual expectation of mining strength and reform implementation.
That contrast, a market powered by policy pledges and two tech titans in Korea,
Right.
versus one driven by the hope of a ceasefire in Israel, and a third defined by political shock in Chile. It tells us so much about 2025.
It absolutely proves that you can't rely on those generalized global growth narratives. Local political leverage was the alpha generator.
And if you are finding this kind of detailed analysis helpful for cutting through the noise and understanding the why behind these global movements, we really encourage you to like this deep dive, subscribe to the channel, and maybe leave a comment telling us which of these three market moves, Korea's tech surge, Israel's confidence rally, or Chile's political pivot, surprised you the most.
Your engagement really helps us keep customizing and delivering these deep dives.
Okay, so now let's pivot and examine the flip side. What drove markets deep into the red, or at least into stagnation?
Let's do it.
We have to start with Saudi Arabia. The Tadawul All-Share Index, the TSI, was the only major index on our list to end 2025 deep in the red. It dropped approximately 13%.
To put it simply for you, Saudi Arabia's TSI is basically a stock index built on the price of Brent crude.
So when the crude price drops,
the TASI is mathematically obliged to follow. Brent crude prices dropped about 15% throughout 2025. So that weak energy revenue translates directly into profound pressure on the Saudi market.
And it wasn't just the price drop. We heard about the regional geopolitical risk premium deflating. What does that mean in practical terms?
Well, when regional tensions ease, as they arguably did a bit in 2025, that built-in cushion, that risk premium that makes oil more expensive because of supply fears, it deflates.
So it's a double whammy.
It hurts oil revenues twice over, lower physical demand, and lower perceived risk. It just deepened the energy sector's weakness.
We also saw some significant domestic pressure on liquidity, even separate from oil.
Exactly. There was a lot of IPO traffic throughout the year, which sucked cash out of the market. When new stocks come to market, existing shares often suffer a liquidity squeeze.
And the biggest stock of all,
Saudi Aramco, the cornerstone of the index, lost about 15% of its value, its weakest year since 2019.
And even their usually robust banking sector wasn't immune, which is a big concern for anyone looking for diversification there.
No, it wasn't. The financial sector was under sales pressure. You had Al Rajhi Bank losing 2.1% on December 16th alone.
So what's the outlook?
Official projections anticipate a 2026 recovery, but, and this is a big but, it is strictly conditional on three major factors:
Return.
rate cuts, liquidity increasing in the local market, and critically, oil prices stabilizing. It's a market held hostage to global commodities.
Okay, let's move to a completely different story. Denmark's OMXC25. This is fascinating to me. A highly developed economy 2025 growth forecast was actually raised to 2.6%.
Right.
Yet the index ended the year barely positive, up only 2 to 3%. What happened?
This is a textbook case of concentration risk working in reverse.
Yeah.
The Danish index is dominated by global giants, and one stock caused a drag that just overwhelmed all the strong local macro data.
And that stock was
Novo Nordisk.
the pharmaceutical company famous for its obesity treatments like Wegovy.
Precisely. After years of high performance, the market, well, it dramatically misjudged the sustainability of its growth trajectory. This forced a massive concentrated correction in 2025. Its price was cut roughly in half over the year.
In half.
Yeah, and that created an enormous headwind for the entire index.
So to put that in perspective, the index was basically held hostage by one company's volatility despite other high-performing stocks.
Totally. Look at Maersk, the logistics and shipping giant. They rose about 30% due to global sea trade recovery signals, a very strong performance.
Right.
Vestas, a leader in wind turbines, also showed relative strength. But the 50% drop in Novo Nordisk, which carries massive weight on that index, completely negated those wins.
They did manage a bit of a late-year bounce, though, right?
Yes, its price jumped 10% in December after the U.S. approved the Wegovy pill form. But that late jump couldn't undo the damage. The lesson here is clear. Global factors can completely outweigh strong local macro data when your index is that concentrated.
Finally, we move to Southeast Asia, Malaysia. The FBM-KLCI closed 2025 with only moderate gains, up about 2.3%. It avoided the red, but it certainly wasn't soaring.
Right.
What kept this market from a bigger rally?
The market found stability, which is a positive, but not the explosive growth we saw elsewhere. That stability came from currency strength. The ringgit hit a 5-year peak in December.
Which helps attract foreign investment.
Limited foreign investment, yeah. And there's also strong government support.
Which support programs are we talking about here?
The Madani Economic Program, which targeted strategic sectors like banking, construction, and renewables. Low inflation and a stable political environment provided a critical floor for the index. But investment expectations just failed to fully materialize.
And looking at the component stocks, financials like Maybank and CIMB saw a pretty limited movement.
They did. Consumer sectors like Nestle Malaysia and Dutch Lady were a bit livelier. But on the other hand, energy companies like Tenaga National and some industrial stocks saw losses toward the end of the year.
So it mirrors some of that global commodity pressure.
It does. The overall picture is a stable market that's just waiting for those ambitious policy goals to translate into actual corporate revenue growth. It's a market built on a strong floor, but it lacks a catalyst to break through the ceiling.
Okay, let's synthesize these 6 very distinct markets. Wildly different outcomes. What connects the 3 winners? South Korea, Israel, Chile.
And what ties the 3 underperformers together.
Exactly.
What's fascinating here is just the sheer diversity of drivers you needed to generate those extraordinary returns. The winners were powered by either, radical policy intervention and tech concentration, like in Korea,
right,
or dramatic geopolitical shifts, like in Israel, or profound political change married to a commodity boom, as we saw in Chile. In all cases, the change was dramatic and it was fast.
And the common thread for the laggards.
They suffered from predictability or extreme vulnerability. They either had direct commodity dependence, like Saudi Arabia, or they suffered from extreme single stock volatility, like we saw in Denmark and to some extent Malaysia.
So for Saudi Arabia, the problem was external oil prices. For Denmark, the problem was the internal index structure.
Exactly. It highlights that for you, the learner, being well-informed means looking past these generalized global economic cycles. The real utility here is seeing that domestic policy and index concentration risk were the dominant forces in 2025.
That's where the alpha was truly generated?
Well,
or destroyed?
If we connect this to the bigger picture, the performance of these 6 markets confirms that in 2025, local political and policy actions, rate cuts, government pledges, election outcomes, they overshadowed the traditional global economic cycles. The local narrative determines success.
So what's one thing to mull over as you finish your deep dive into these results? Consider whether the high concentration risk we saw in the KOSPI, where just 2 stocks drove half the gain, and the OMXC25, where Novo Nordisk volatility dominated. Consider if that makes these spectacular results fundamentally more fragile than market analysts realize. Is a 75% return built on two stock names sustainable? Or is it just a one-time outlier? That's something for you to explore on your own.
Thanks for joining us for this deep dive into the 2025 Global Index Scorecard.
We look forward to diving into your next stack of sources.
Until next time.